Michael Burry, the investor who predicted and profited from the 2008 housing crisis, has spent the past year sounding an increasingly urgent alarm. He says an AI-fueled bubble is building, capital is being committed at a scale that makes past manias look small, and when it breaks, the damage will be systemic. His warning is blunt: this bubble may be too big to save. This isn't speculation. Burry has put real money behind this thesis. Regulatory filings show he holds put options on major AI beneficiaries, primarily Palantir Technologies and Nvidia. The exposure, roughly $1.1 billion. That's not a small bet, and the math behind it tells you everything you need to know. The core issue is simple. Many of the companies driving the AI mania don't generate sustainable profits. They burn cash. Their valuations are built on expectations of future profitability that may never materialize at the scale the market is pricing. Take OpenAI as the clearest example. As of late 2025 into early 2026, OpenAI generates roughly $8 to $10 billion per year in revenue from ChatGPT subscriptions, API usage, and enterprise contracts. At the same time, it spends approximately $23 to $30 billion per year, primarily on compute infrastructure, GPUs, data centers, electricity, long-term infrastructure commitments, and top-tier engineering talent. The gap between those numbers results in ongoing cash burn of about $15 to $20 billion per year, or roughly $4 to $5 billion per quarter. In simple terms, OpenAI loses money because every increase in usage immediately increases compute costs, while pricing and monetization lag behind. The company is deliberately accepting massive losses to stay ahead in the AI arms race, betting that future models will be far cheaper to run and far more profitable. If that assumption fails, the current valuation cannot be sustained. And what is that valuation? Experts and secondary market pricing put OpenAI at roughly $500 to $750 billion. The most commonly cited anchor is approximately $500 billion from late 2025 private transactions, with IPO speculation ranging up to $1 trillion in aggressive bull cases. A company burning $15 to $20 billion annually is valued at $500 billion to $1 trillion. That valuation assumes the cash burn stops, monetization catches up, and future profits justify the price. If any of those assumptions prove wrong, the valuation collapses. There is no earnings floor. The entire value rests on belief about the future. Look at the fundamentals across the sector. Artificial intelligence infrastructure requires enormous capital expenditure. Data centers cost billions to build and operate. Chips are expensive. Training large language models requires massive compute resources. Companies racing to capture AI market share are spending at unprecedented rates, and much of that spending is not generating immediate or even near-term returns. These aren't profitable, mature businesses being valued at high multiples because of stable cash flows. These are companies with negative or minimal free cash flow being valued as if they will dominate entire industries indefinitely. The business model, in many cases, is spend heavily now, acquire users or contracts, hope to monetize later at scale. That model works if monetization actually happens. It fails catastrophically if it doesn't. Palantir, one of Burry's primary targets, is instructive. The company has been valued in the hundreds of billions of dollars. It operates primarily in government contracts and has struggled to scale commercial revenue at the pace its valuation implies. Revenue exists, but the path from current operations to justifying a valuation of that magnitude requires near-perfect execution and sustained growth that may not be realistic. Nvidia is different in that it actually generates significant revenue and profit from selling chips, but the valuation, which has reached multi-trillion-dollar market capitalization, assumes sustained demand for AI infrastructure at current or accelerating rates. If corporate spending on AI slows, if the expected return on AI investments doesn't materialize, or if competition compresses margins, Nvidia's valuation becomes difficult to defend. The company is profitable, but the multiple applied to those profits assumes a future that may not arrive. The broader AI ecosystem is filled with companies that are burning cash to capture market share in markets that may not be as large or as profitable as current valuations assume. When profitability is distant or speculative, valuations become untethered from fundamentals. That's when bubbles form. The math is straightforward. A company losing money or generating minimal profit cannot justify a valuation in the hundreds of billions unless investors believe future cash flows will be enormous. If those future cash flows don't materialize or take longer to arrive than expected, the valuation collapses. There's no floor based on current earnings because current earnings are insufficient or negative. The entire valuation rests on belief. When belief breaks, prices fall sharply. The AI bubble isn't just about high valuations. It's about leverage. Borrowed money and financial engineering amplify both the rise and the fall. Corporate leverage is the first layer. Companies are borrowing to fund AI infrastructure buildouts. Hyperscalers, the large cloud providers, are committing tens of billions of dollars annually to expand data center capacity. Much of this is financed through debt or structured carefully to maintain investment-grade credit ratings while maximizing capital deployment. If the revenue from AI services doesn't materialize at expected levels, those debts still need to be serviced. Leverage turns a revenue shortfall into a solvency question. Investor leverage is the second layer. Hedge funds, private equity, and individual investors use margin, options, and derivatives to increase exposure to AI winners. Options, like the puts Burry bought, are inherently leveraged. For a relatively small premium, an investor controls a large notional position. This works in both directions. Bullish investors buying call options or using margin to purchase shares are taking leveraged long positions. If prices fall, margin calls force selling, which accelerates the decline. Burry's trade illustrates this mechanism. He paid $9.2 million for exposure to $900 million worth of Palantir shares. If Palantir's stock falls significantly, the value of those puts increases by multiples of the premium paid. But the same leverage exists on the other side. Investors who sold those puts to Burry or who hold leveraged long positions in Palantir or similar stocks face magnified losses if prices drop. The danger is the cascade. When leveraged positions unwind, they don't unwind slowly. Margin calls happen fast. Option sellers who are short volatility or short puts face sudden mark-to-market losses that force them to hedge by selling the underlying stock or buying more puts, which pushes prices down further. This creates a feedback loop where falling prices trigger more forced selling, which causes more price declines, which triggers more selling. This is not theoretical. This is exactly what happened in past bubbles. The 2000 dot-com crash and the 2008 financial crisis both involved leverage amplifying initial price declines into systemic stress. The AI bubble has the same structure. High valuations plus widespread leverage equals fragility. The scale of leverage in the current system is difficult to measure precisely because much of it is embedded in derivatives and structured products that aren't fully disclosed. But the existence of leverage is undeniable. Options volume on AI-related stocks is enormous. Margin debt levels, while not at all-time highs, remain elevated. The infrastructure for leveraged speculation exists and is being used. When the bubble breaks, leverage turns a valuation correction into a liquidity crisis. Prices fall, leveraged players are forced to sell, liquidity dries up, and the decline accelerates. The math is mechanical. The outcome is predictable. Here's where the math becomes brutal. AI companies are valued primarily on expectations of future cash flows. When interest rates rise, the present value of those future cash flows collapses. This is basic finance, but the magnitude matters. The present value of $1 expected 10 years from now is approximately 69 cents if discounted at 3.75%, the current upper range of the Federal Reserve's target rate. If the discount rate rises to 8%, that same dollar is worth only 46 cents today. At 12%, it's worth 32 cents. What this means in practice is that a company expected to generate significant cash flows a decade from now sees its valuation cut by 1/3 to 2/3 as discount rates increase. The further out the expected cash flows, the more sensitive the valuation is to interest rate changes. AI companies are extreme examples of long-duration assets. Their valuations are built almost entirely on cash flows expected many years in the future. Current profits are minimal or negative. All the value is in the belief that these companies will eventually dominate markets and generate enormous returns. When discount rates rise, those distant cash flows become worth much less in present value terms. The Federal Reserve raised interest rates aggressively over the past cycle to combat inflation. As of mid-January 2026, the effective federal funds rate sits in the 3.50 to 3.75% range. That's significantly higher than the near zero rates that prevailed for much of the prior decade. The market has adjusted to some degree, but many AI valuations still reflect assumptions formed during the low-rate era. If rates stay elevated, or if they rise further due to inflation concerns or fiscal pressures, AI valuations face continued downward pressure. If rates fall, valuations get relief, but the direction of rates is uncertain, and the fiscal backdrop suggests rates may not fall as much as markets hope. This is where Burry's warning becomes concrete. He's not predicting rates will spike to 12% tomorrow. He's pointing out that even modest increases in required returns or risk premiums can cause massive valuation destruction for companies whose worth is entirely tied to distant, uncertain cash flows. The math is unforgiving, and the math gets worse when you consider that many AI companies don't just need low discount rates, they need access to cheap capital to fund ongoing operations. If borrowing costs rise, cash burn accelerates. If capital markets tighten, funding becomes harder to secure. Companies that were relying on continuous access to low-cost financing face existential pressure. The discount rate problem is not speculative. It's arithmetic. Higher rates mean lower valuations for long-duration assets. AI companies are the most extreme long-duration assets in the market. The sensitivity is measurable and severe. This is the critical difference between the AI bubble and past bubbles. In 2008, the government could intervene. The Federal Reserve cut rates to zero, expanded its balance sheet from $800 billion to over $4 trillion, and flooded the system with liquidity. The Treasury committed $700 billion through TARP to stabilize banks. Congress passed massive stimulus. Government debt at the time was roughly $10 trillion. Interest payments on that debt were approximately $250 billion annually. The fiscal situation allowed aggressive intervention. The system was saved at enormous cost, but it was saved. That option may not exist this time. The United States federal debt has climbed above $37 trillion. Interest payments on that debt now exceed $1 trillion annually and are rising. The fiscal situation is fundamentally different than it was in 2008. When the government has limited fiscal space, its ability to respond to crises is constrained. Large rescue packages require either raising taxes, cutting other spending, or borrowing more. Borrowing more when debt is already at record levels and interest costs are rising becomes politically and economically difficult. Markets begin to question the sustainability of government finances. That questioning can raise borrowing costs further, creating a vicious cycle. Additionally, the scale of the AI bubble may simply be too large. If trillions of dollars in market capitalization evaporate across AI-linked companies, if data center investments become stranded assets, if corporate spending collapses and triggers a broader recession, the magnitude of intervention required could exceed what the government can credibly deploy. Burry's phrasing, "too big to save," captures this dynamic. The 2008 crisis involved financial institutions that were too big to fail because their collapse would destroy the payment system and freeze credit markets. The government stepped in because the alternative was systemic breakdown. But the intervention was possible because the government still had fiscal and monetary capacity. In 2026, that capacity is diminished. The Federal Reserve's balance sheet is still bloated from prior interventions. Interest rates are higher, but not high enough to provide much room to cut. The Treasury is running large deficits with debt at unprecedented peacetime levels. The tools that worked in 2008 are less available and less effective. If the AI bubble bursts and the damage is broad, the government faces an impossible choice: intervene aggressively and risk a fiscal crisis, or let the correction play out and accept the economic pain. Neither option is attractive, and the outcome in either case is severe disruption. This is not about predicting government policy. This is about recognizing that the constraints are real and binding. The government's ability to stabilize asset markets is not unlimited. When debt is high and fiscal space is limited, rescue capacity is reduced. The math doesn't care about political will. The constraints are structural. Burry has been clear that timing the exact top of a bubble is nearly impossible. Bubbles often last longer than logic suggests. Prices can stay irrational far longer than short sellers can stay solvent. But the structural imbalances are real, and when they unwind, the process is not orderly. The dot-com bubble provides a template. The Nasdaq peaked on March 10th, 2000 at 5,048 points. It bottomed on October 9th, 2002 at 1114 points, a decline of 78% over roughly 2.5 years. The crash erased approximately $5 trillion in market value. Companies that had been valued at hundreds of millions became worthless within months. Over 50% of publicly traded dot-com companies failed by 2004. The Nasdaq took 15 years to reclaim its March 2000 peak, finally reaching it again in April 2015. The AI bubble is larger. Multi-trillion-dollar market capitalizations concentrated in a handful of names create greater systemic risk. The capital committed to AI infrastructure, data centers, and chip capacity exceeds what was deployed during the dot-com era. The leverage embedded in options, margin debt, and corporate borrowing amplifies potential losses. When the AI bubble breaks, the damage spreads through capital spending first. Companies that were planning massive infrastructure build-outs delay or cancel projects. Chip demand falls, data center construction slows, vendors and suppliers that were counting on sustained AI spending see revenue projections collapse. Earnings disappoint across the entire supply chain. As stock prices fall, wealth destruction becomes broad. Mega-cap technology companies that benefited from AI hype see valuations compress. Index funds heavily weighted toward these companies suffer. Pension funds, endowments, and retail investors holding these funds experience losses. If the correction is severe enough, reduced household wealth impacts consumer spending. Business investment drops as uncertainty rises. Unemployment increases. A stock market correction becomes an economic recession. This is not a prediction of exact events. This is a description of the mechanical process by which asset bubbles unwind. The dot-com crash followed this pattern. The 2008 financial crisis followed this pattern. The structure is the same. The scale this time may be larger because the capital committed is enormous and the concentration is extreme. Burry is not saying this will happen tomorrow or next month. He is saying the conditions for a disorderly unwind are present, the risks are asymmetric, and the prudent course is to recognize those risks rather than assume they will resolve without consequence. Look at what Burry is actually risking. He paid roughly $9.2 million for put options on Palantir. If Palantir's stock falls significantly, those puts increase in value by multiples of the premium paid. If the stock stays flat or rises, the puts expire worthless, and Burry loses the $9.2 million. That's a leveraged bet with defined downside. The maximum loss is the premium paid. The potential gain is much larger if the thesis is correct. This is not reckless gambling. This is a calculated position based on analysis of valuations, leverage, and structural risks. The thesis is straightforward. AI companies are valued at levels that assume massive future profitability. Many of those companies are currently burning cash, not generating sustainable profits. The valuations are built on belief, not current fundamentals. Leverage amplifies both the rise and the fall. Interest rates, if they stay elevated or rise further, compress the present value of distant cash flows. The government's ability to intervene is constrained by record debt levels. If any of these conditions shift adversely, valuations face severe downward pressure. The math supports that conclusion. It's not speculative, it's arithmetic. Burry is known for making large, contrarian bets when he identifies structural imbalances. He shorted subprime mortgages before the 2008 crisis because the math showed those securities were mispriced relative to default risk. He was early, he was ridiculed, and he was ultimately proven correct. The profit was enormous because the market took time to recognize the problem, but the analysis was sound from the beginning. This situation has similar characteristics. Extreme valuations disconnected from current cash flows, leverage embedded throughout the system, a catalyst, higher interest rates that mechanically reduces valuations, fiscal constraints that limit policy responses. The structure is there. The risks are measurable. The market can ignore these risks for a time. Prices can continue rising as momentum and belief drive buying. But that doesn't mean the risks disappear. It means the eventual correction, when it comes, will be more severe. Burry's warning is not that AI technology is worthless or that these companies will cease to exist. The warning is that the valuations are unsustainable, the capital committed is excessive, and the unwind will be painful. That's a reasonable assessment based on the evidence. Well, Michael Burry is not predicting the exact date the AI bubble bursts. He is identifying structural imbalances that make a disorderly correction likely and potentially severe. The math behind AI valuations doesn't work if you assume realistic cash flows and elevated discount rates. The leverage embedded in the system amplifies both gains and losses. The government's ability to intervene is limited by record debt and constrained fiscal space. This is not fear-mongering. This is pattern recognition based on measurable data. The valuations are extreme. The cash flows don't justify them. The leverage is real. The constraints are binding. Investors have choices. They can recognize these risks and adjust positioning accordingly. They can take profits on positions that have appreciated significantly. They can reduce leverage and exposure to highly speculative names. They can build cash reserves to deploy when valuations become more reasonable. Or they can ignore the warning and assume this time is different, that AI will revolutionize everything so completely that current valuations will look cheap in hindsight, that the government will intervene if things go wrong, that leverage doesn't matter when prices are rising. History suggests the latter approach ends badly. Bubbles always feel different while they are inflating. The narrative always sounds compelling. The profits are real until they're not. And when the bubble bursts, the damage is always worse than optimists expected. Burry has made a calculated bet that AI valuations are unsustainable and that an unwind is coming. The math supports that bet. The history of bubbles supports that bet. The structural imbalances are visible and growing. What you do with that information is your choice. But ignoring it because it's uncomfortable or because prices are still rising is not analysis, it's hope. And hope is not a strategy when the fundamentals don't work. Thanks for watching The Money Timeline.